Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the market analysts here at HF Markets. A lot of people already know me. I'm a well-known market analyst, been a financial advisor in Canary Wharf in London for a long time. So a lot of people already know me. They've watched a lot of my webinars, but maybe potentially today it's a webinar where individuals are joining without they have never previously watched a webinar, potentially beginners, potentially somebody who has never traded before, or somebody who potentially could have traded in the past, taken a very long break, and needs an educational session where they can relook at everything which they've already learned in the past as part of their experiences. So we've got different people as part of today's webinar. Today's webinar is, of course, aimed at individuals who are very new to the financial trading market. So individuals potentially who have never traded or have some experience in the market, for example, maybe only trading 2-3 months. And there's, of course, less for individuals who are experienced professionals, institutions, and so on and so forth. We've got, of course, certain webinars which are more based for those individuals. For example, we had a recent webinar where we were looking at more advanced trading strategies and so on and so forth. But today, what we're going to do is really show individuals why individuals are trading, what is involved when individuals are trading, if we are trying to build portfolios, or if not, what kind of methodologies are we looking at? How are we able to determine how the market's going to move? Because, of course, if we are able to determine how a price of an asset is going to develop over a specific period of time, then of course, when you're able to do that, you've done 75% of the task. It's just about making sure that the mathematics and the statistics within your trading plan are allowing you to be a successful and profitable trader. So these are the type of things that we're going to look at as part of today's webinar, of course. Now, before we get started, as part of this slide, very quickly, I want individuals to be aware that, of course, here at HF Markets, we are dealing with investments. And of course, as always, when we are dealing with investments, there's of course a risk to the capital that we are investing. Now, this is because, ladies and gentlemen, of course, you may be purchasing an asset, you may be selling an asset, you may be speculating in either direction of the market. But when you are doing so, of course, we have no control over how the price is likely to move. So you have to understand that you've got to be comfortable with it before proceeding to a full investment. Now, a lot of people probably watching the webinar already know me. They've known that I've been a market analyst for a very long time now. I've also been a financial advisor in London. But of course, these webinars are here not to give investment advice, not to tell you what you should be buying, what you should be selling at which prices, and so on and so forth. These webinars are here for educational purposes. So rather than us telling you or advising you or recommending to you what to do, when to buy and sell, what we do is we provide as much educational material as possible in order for you to be able to take advantage of the financial trading markets with experience, with knowledge, and with expertise. So this is what we want to achieve as part of our, not necessarily just part of today's webinar, but our webinar series, because we have 2 to 4 webinars every single week. And of course, each webinar is based on something different. Today's webinar is more an introduction, getting a feel for the financial trading market, looking at what different options are available to everybody, and so on and so forth. Now, this is the last page that we're going to look at as part of our introduction. To be honest, I don't really like this page because it's not going to make you any money. It's not going to give you any knowledge. It's not going to make you a better trader. But I do think to a certain extent, it is important to know a little bit about the individuals who are providing you with the information. So, a bit about my background. My name is Michalis. I'm here in the head office. I am one of the market analysts here. A bit about my background. I've been in the financial trading markets for 10 years now. Originally, I was a financial advisor. That was just for over 4 years. That was in London. Since then, I've been a market analyst for 6 years though. So altogether, I've been in the financial service market for 10 years. Each webinar, like I said, is based on something different. So of course, certain webinars are more aimed at beginners. And then we've got, of course, more advanced webinars. The advantages here at HF Markets, having an individual who has really been involved in institutional trading, been a financial advisor, an experienced market analyst, is that we're not going to be looking at only very simple factors of the market. Yesterday, maybe we're going to be looking at mainly simple aspects, but the advantages, ladies and gentlemen, is that we can also look at things which are more advanced. So for example, looking at cumulative delta, for example, looking at the volume weighted average price, and so on and so forth. So trading basics. What I want people to understand as part of this slide is exactly what is available here on our platform and how exactly are you able to take advantage of it. So how are you able to attempt to earn a profit while trading? What exactly are traders doing? Who are traders? This is what we're looking to understand at very first as part of this slide. So point number one, traders are looking to speculate how the price of an asset is going to move within a specific period of time. Now, there's two things for you to note as part of that slide, ladies. That first point. The first section is how to speculate. To speculate how the price of the asset will move. This is the first section. The second section is within a specific period of time. Now, that is something extremely important as well, because some people may come to the financial trading market and they may say, I know what markets are trending. I know that the technology market is trending. I know that technology is the future. So I know if I buy anything which is related to technology, maybe I won't earn a profit today, maybe it won't be this year, but I know in 10 years time, anything that I buy is going to be worth a lot because that's what's trending. And we know that, of course, in the future, technology is the way forward. So it's relatively simple. And what people need to understand, first thing, of course, it's great that somebody is analyzing the market in that way and looking at the market in that way. So I'm not trying to disarray individuals or discourage them. But what people need to understand is there is trading and there's building a portfolio. And there's a very big difference between the two. This is also under point number 2 as well. So you can see we need to understand the difference between trading and the difference between building a portfolio. If we're building a portfolio, of course, we're not so related to the risk of time or the risk of entry and exit, but more so what we actually are doing is trying to identify where in the long term there is potential for an asset to increase in value. So of course we need to take into consideration inflation, especially if we're looking at commodities. We need to take into consideration the financial conditions of a company, if we're related to a stock, earnings, products, industry, and so on and so forth. But the timing of the investment is less important. It's very simply more related to what price are we entering? Are we entering at the right price? Are we entering below the intrinsic value? If the intrinsic value in 10 years time, 15 years time, what level is it going to be at? And based on that, we determine what asset to include as part of our portfolio. We don't care what's going to happen today. We don't care what's going to happen this year or the year after, because we're looking at where the price is going to be in 10 years time. When we look at trading, trading is designed, and especially the assets, for example, derivatives and CFDs and futures and warrants, all these different assets are designed for short-term trading. Now, trading is when you're active in the financial trading market. So you enter, you earn, you exit. You enter, you earn, you exit. This is also why people a lot of the time turn to trading for passive income rather than somebody trying to beat inflation and try to better his savings via building a portfolio. or try and earn on a yearly basis, for example, through dividends and yields and so on and so forth. So there's a very big difference between trading and building a portfolio. So yes, 50% of trading is that you need to be able to identify how the price is likely to move. And we have a lot of webinars which look exactly at strategies, well-known strategies, where you can identify this is where I need to buy, this is where I need to exit the trade, this is where I need to sell, this is where I need to exit the trade, and so on and so forth. But today we're looking at the basics at first anyway. So 50% is, yes, we need to be able to look at an asset and we need to be able to determine how the price is going to move. This is what is known as speculating. You're speculating that the price is either going to increase or you're going to speculate that the price is going to decrease. There's also other options as well, such as hedging, in which case you're speculating that the price could move in either direction. There's mean reversion methods as well, in which case you're speculating more of a sideways price movement, but we're not going to go more advanced just yet anyway. But because we're trading and not building a portfolio, it's very important that we are able to identify the specific period of time. So there's no point, for example, let's say if we look at an upward trend like this, ladies and gentlemen, and we analyze the market, let's say this stock is worth around 110 US dollars. We're analyzing the market and we think by the end of the week it's going to increase all the way up to here to 125 US dollars. There's no point trading today as the price does something like this over the next 48 hours, and then on Monday it does something like this, because you're over 2 days losing money. This is volatility and price movement that you could have actually been speculating and earning from that price movement. And you're entering at the wrong price, because you're entering at the price and the time when the market's about to move against you. And especially as beginners, in that time period, in that 48 hours, you need to be able to keep your cool and hold on to the trade and wait for the trade to start to move into your favor. Whereas a more professional, experienced trader would say, this is the wrong price to be entering, and this is where you actually need to be entering. So it's partially speculating in the direction, identifying how the market is going to move, but also to identify what period of time is the market going to move. So when I'm analyzing the markets, I'm saying, yes, I'm opening a trade. I'm, for example, yesterday, opening a buy on the NASDAQ, sorry, on Dow Jones, and I believe it's going to move in this direction over the next 3 hours. So you can see exactly what I'm doing. Asset, price, direction, time period. So this is something, of course, that we need to understand as beginners. Moving on, we've already covered point number 1 and 2. Moving on to point number 3. Trading should be considered as a business. Now, when we're looking at business, if we've got individuals who are self-employed or have limited companies, we always think of a company and a business in terms of its turnover, in terms of expenses and dividends. So how can I relate that to trading? Something that I mentioned as well is passive income, people earning an income from trading. Whether you're looking to earn dividends on a monthly period, if you're looking to earn dividends on a quarterly period or on an annual period, whatever that may be, it could be weekly even. So we need to understand when we're trading, we're going to have trades that are going to be in profits. And when I say in, I mean close in a profit. If you've got an open trade and the trade is in a profit, you are not profiting. It's only a profit if you close the trade. Until you are closing the trade, it's not a profit. We can refer to it as a potential profit. So there's profit and there's trades that we will close in a loss. You have to understand that without a doubt, within your experience and within your time while you're trading, there will be trades that you believe the market's going to move in a certain direction, but it moves in another direction and you close the trade in a loss. And it's not a bad thing. The same thing applies to when you've got a business. And this is why I say you have to think of it as a business. There's turnover and there's expenses. So there is profitable trades and trades that you close in a loss. Now, it's not an issue. The only thing that you need to ensure is that the turnover is higher than your expenses consecutively, not as a one-off, but consecutively. So that way you're able to generate an income stream. And then the other thing is you're generating enough income in order for you to be able to meet your dividend requirements. When I say dividends, of course, we're referring to withdrawals that you're making, because of course we want to earn in order to spend, in order to look elsewhere. People may simultaneously be trying to look at a portfolio as well as trading, and so on and so forth. A successful trader needs to be able to have a successful trading plan as well as a successful strategy. This is something we'll look at later on in the webinar. It's not good enough to have a strategy alone. So you may have a strategy, the strategy may have an 80% success rate. What do I mean by 80% success rate? Let's say each week you're opening 10 trades. If you've got an 80% success rate, so for example, 10 trades, you have an 80% success rate. That means, ladies and gentlemen, 8 of those 10 trades are in a profit. Yes, you need a successful trading strategy, but ladies and gentlemen, you also need a successful trading plan. Why? Because you could have an 80% success rate and still be losing as a trader. You may have a 90% success rate and still be losing as a trader. And that's something that, of course, you want to avoid. Somebody could be a very clever trader, and I've met a lot of these individuals. I had this actually conversation with somebody which was very new to the financial trading markets. He's never traded before, and I actually stated to him, you could be unsuccessful, but if you've got the right trading plan, you can still be profitable. And what do I mean by that? Somebody may have a 30% success rate, but if he has the right trading plan, he's still profitable. So that's why I always say, even a beginner trader who doesn't know how to analyze the market, and he may not be doing so successfully, he may have a 50% success rate, a 40% success rate. But if his trading plan is correct and in line with that, at the end of each week, he still will be profitable, as long as he's got the right trading plan. And what I mean by that is the mathematics, the finances behind his trading. And this is something that we're going to look at towards the end of the webinar, something extremely important. We actually have whole webinars which are solely based on that, because that's something which can really turn somebody from a trader which has seen mixed results to an individual who's actually profitable. Now, when individuals are trading, a lot of people turn to trading rather than to building a portfolio, because they have the ability, when they're trading, to speculate in either direction of the market. Now, what do I mean by speculate either direction of the market? Here we're referring to point number 5. If a trader is using derivatives, derivative is an asset. We're going to look at that in the next slide, because of course we need to understand what it is we are trading. If a trader is using a derivative, he's able to speculate that the price can increase as well as decrease. So what is a derivative, and how is somebody able to earn where the price is decreasing? And this is, again, why a lot of people move away from building a portfolio. I'm not saying it's bad to build a portfolio. There's a lot of advantages, amazing advantages to building a portfolio. But this is why a lot of people move away from building a portfolio and turn to trading. Why? Because when an individual is when an individual is building a portfolio, there's only one way he can earn. He has to buy at one price, the price has to increase, he has to sell at a different price. And the difference between the two is his profit. For example, he has to buy 100 and sell at 150, and his profit's 50%. When you're trading a derivative, you can speculate in either direction of the market. So for example, there may be a price movement like this. We're currently, let's say, here at $100 US. You can actually state that I believe the price is going to decline here to $85. So if the price does decline and hits $85, then you've earned a profit of $15, even though the price is declining, because you have speculated a decline. So here you can see, ladies and gentlemen, that individuals have the ability to speculate in either direction of the market. Now, some people may say, if it's declining, who is paying that $15? Sorry, $15 based on this example. And this is where we need to understand derivatives. What is a derivative? A derivative is an investment contract between banks, liquidity providers, brokers, exchange rates, and so exchanges, and so on and so forth. So what is the investment contract? The investment contract, ladies and gentlemen, basically is a contract. Okay, for example, most derivatives on our platforms are CFDs. So here is the asset. It's a CFD. It stands for contracts for difference. This is one method, in terms one asset within the derivative category, and it's an investment contract. So instead of buying the actual asset itself, you can trade an investment contract, a CFD, a derivative, where the price is mimicking the price movement. So for example, you may have NVIDIA stocks, okay, which are priced here, and you've got a CFD, a derivative in NVIDIA stocks. Now, one is the actual asset itself, the real physical asset. The other is just an investment contract. Now, there is no difference between the two in terms of price. As the price of NVIDIA increases or decreases, it will mimic it. It will be the exact same. I can see some questions. I will answer questions in a moment. Just so everybody's aware, everybody has the ability to ask as many questions as they like, as always. So CFDs is an investment contract. It has a price. The price is mimicking the underlying asset, the real asset itself. And there's no difference between the two other than one is just a contract, which allows you to speculate the price movement. The other is buying the real asset itself. So why are individuals accessing and trading instead of the real asset, trading a CFD, the investment contract? And the answer to that is there's a lot of benefits to it. So let's look at some of the benefits of that. Let's say a lot of people are interested in, let's say, the NASDAQ, or let's say the technology market. For example, there's a lot of demand at the moment for Microsoft and NVIDIA and AMD stocks because of demand for AI products, which is understandable. Now, if somebody buys the real asset itself, let's say somebody buys NVIDIA stocks, the real asset, and there is a stock market crash and all stocks are declining. I'll let you know something that everybody knows. When there's a stock market crash, nobody buys. Nobody wants that stock because it's crashing. So what actually happens to you who's a shareholder? You press sell, and what happens is your share goes in a queue to be sold, but nobody's there to buy it because there's a stock market crash. So you're stuck with the investment until the price declines to a level where people start to actually want to buy it again. So this is a bigger disadvantage to buying the real asset itself. Whereas if you're buying an investment contract, there's no buyers or sellers. There's just you speculating how the price may develop. So if there's a stock market crash, that very same second, just click close and it automatically closes because nobody's buying it from you. So there's a lot of advantages to CFDs. This is one of the advantages. So let's look at some of the advantages here. We'll go through each and every advantage. So point number 2, derivatives and CFDs is an asset which allows individuals to speculate an asset's price without buying the real thing. So one advantage is you don't have to buy the real asset itself. An individual may look to invest in a CFD instead of buying the underlying asset because they tend to be cheaper. This is advantage number 1. They offer leverage, and we'll explain leverage in a moment, and they're more easily accessible. Sometimes when the stock is in high demand, it's very hard to get access to that stock. Why? Because there's high demand. Nobody wants to sell their stock. There's a big queue of individuals wanting to buy it. So you have to wait, and you probably will buy it at a more expensive price. This is point number one. Some are hard to get access to. For example, if it's a commodity, how are you going to buy oil? Everybody saw just after COVID-19, oil became very expensive. How are you going to invest in that? The same thing applies to gold. How are you going to invest in gold? You're going to go to your jewelers? How exactly are you going to invest in it? So CFDs make these assets that everybody wants to take advantage of more accessible. So leverage, this is a very big advantage. It's also known as a double-edged sword because if it's used appropriately, there's a lot of advantages. If it's used unresponsibly, there's also disadvantages as well. So what is leverage? Let's get a good understanding of leverage. Leverage, ladies and gentlemen, is basically when the broker or the liquidity provider, the exchange, the bank, whatever it may be, allows you to increase your buying power. So leverage is always shown as a ratio. So for example, you may have a leverage of 1 to 10. This means for every $1 you invest, we increase your buying power by 10. So if you have $1, we're saying with that $1, you can buy anything worth $10. So we are increasing your buying power by 10. So for example, if you have a stock which is worth $100 and you have invested $100, normally if you didn't have leverage, you could only buy that one stock. Okay, if you've got a leverage of 1 to 10, you have two options. You have an option of just buying one stock again, so you're not increasing your exposure in any way. You only buy one stock, but instead you only pay $10 for that one stock. Option number two is instead of buying one stock, because you've got a leverage of 1 to 10, you can increase your exposure. Of course, it's up to you whether you do or not. And instead of buying one stock, you can buy 10 stocks. So we are increasing your buying power. And it also means that you require less to buy more expensive assets. So for example, somebody mentioned to me in the last webinar that he believes a lot of stocks which are related to weapons, armory, warfare, and building these assets are going to become very expensive over the next 2 to 8 years, he said to me. The issue is those stocks are very expensive. Some of those stocks are 600, 800, some are worth over 5,000, for example, US dollars. So they're very expensive. So an advantage is that you can use leverage and it makes the entry and the access cheaper for all individuals. So this is for example, a good advantage of leverage, a good way of understanding leverage as well. Now, also did say that there is disadvantages to it if you're using it inappropriately, if you don't fully understand it and using it in the wrong way. When you increase your leverage, you are increasing the potential profit, but at the same time, you increase volatility. And of course, when there's more volatility, there is potentially more risk as well. So for example, if you've got 10, let's say you want to invest $10, you've got a leverage of 1 to 10, which means you can buy a stock worth $100. So the asset is, and its volatility level is based on real stock. It's 100. You've invested $10. Now, if the price declines to $95, you've lost 50% of the stock of your investment. You've lost 50%. Whereas if you didn't use leverage and you invested 100, you would have lost 5%. Because you invested 10 and you're using leverage of 1 to 10, is 50 because it's declined by 5 and you had $10. So now you have $5. So you've lost 50. If it goes up to $105, for example, you've earned 50%, which is very high. Imagine somebody saying, you know, you buy something, it's going to go up $5 and you're going to earn 50%. Think about in our banks, we're earning 1% if we're lucky. So you can see there's advantages and there's disadvantages. It's just about using leverage in the right way. And there's a lot of things that we're going to talk about as part of today's webinar to ensure that you are using leverage responsibly and to your advantage. Now we're going to go through this very quickly, okay? Because a lot of people know what a lot of these assets are, but we're going to go through it because, of course, we've got individuals who don't even have an account, have never traded, have never thought about an investment before. So we're going to go through it step by step. So as part of this slide, we're going to look at what options you have in terms of investing. What can I invest in? And a lot of people are going to say to me, what is the most popular? What is going to be the easiest to trade? And so on and so forth. And we're going to look at trying to answer some of these questions as well. So point number one, Forex. What is Forex? Forex stands for foreign exchange, and it's basically just an exchange rate. So you have the euro against the US dollar, you have the pound against the US dollar, you may have exchange rates related to the naira, to the rand, to exotic currency pairs, and so on and so forth. Now, what you need to understand is a currency is always a pair. It's not being traded alone, it's always a pair. Why? Because a currency must have a value against another currency. So for example, even a stock is also to an extent a pair as well. For example, it may be Apple stocks. So for example, Apple, please ignore my handwriting because I'm using a computer mouse. Apple stocks are also a pair. It will be Apple against the US dollar. But you'll never see it like that. But with a currency pair, you will always see what is being valued in. Okay, so think about it in this way. So this is why it's always two currencies, the euro against the US dollar, the US dollar against Japanese yen, and so on and so forth. Now, we've got a question here. Let's quickly answer this question. Okay, this is a great question. Basically, what the individual I think is trying to say is, how can I better my analysis of trading currencies when I'm analyzing currencies? What I will say is, what you definitely can do is there's advantages, because a lot of beginners, they look at a currency pair as a single asset, but there's actually advantages of looking at the asset as three assets. And this will definitely improve your analysis. So always think about, and let's say if we look at the most traded currency pair, the most traded currency pair is the euro against the US dollar, like this, okay? Instead of looking at it as one asset, think of it as three assets. You analyze the euro against the USD, so that's one asset. You analyze the euro, that's two assets. The euro alone, that is, and we also individually analyze the US dollar, so that's three assets. You analyze the euro USD, the euro, and the US dollar. And you can also use the euro index and the US dollar index to help you with that as well. We've also got that available on our website. Got another question. So I've got somebody here who's saying, how do I read this? How do I read this? Gold sell 2,161, 2,158. Am I supposed to sell gold within this range? To be honest, I don't know what you're referring to. It's difficult for me to say because it's not something that I can physically see here. It sounds like this is the range for you to consider selling the asset. Okay, so this is what it sounds like. Within this range, there is potential for the asset to decline. This is what it sounds like. Okay, again, though, I cannot see what it is where you're reading it from. So it could be the breakout level that you're reading from. It could be a Fibonacci level. So it's difficult for me to answer, but by the sounds of it, it's the trigger point. So hopefully that helps you. So this also answers the other question as well. think of currency pairs as three assets when you're analyzing. So what is going to affect the supply and demand, so the price of currency pairs? The main thing, ladies and gentlemen, will be risk sentiment. So if people have a low risk sentiment, so they're risk averse, they don't want to risk, what actually happens is everybody opts for cash. Everybody wants cash, and they don't want equities, they don't want cryptocurrencies, and so on and so forth. They want cash. For example, if somebody says to you, you're about to lose your job, without doubt, you will stop spending, and you may have some investments that you will actually sell and prefer to have cash. The same thing applies to currencies. If there's a low risk appetite, currencies tend to perform better. Interest rates, keep in mind when interest rates are high, it supports currencies. Inflation, the same thing applies, supports currencies because high inflation trigger high interest rates, which trigger a low risk sentiment. So you can see there's a domino effect here, ladies and gentlemen. Economic outlook, when there's a strong economic outlook for a certain country, of course, there's demand for that currency, because if you want to invest in a currency, ideally you want to invest not in a failing economy or a failing state, but you want to invest in something which is stable and has a lot of economic growth and so on and so forth. Stocks. What is stocks? Stocks is basically you're purchasing a part of a company and you're given an ownership certificate. They are bought on an exchange most of the time. Any of the large companies, without doubt, will be bought on an exchange. So basically investing into a company and you're purchasing a stock which is giving you a part ownership of the company. This is very popular. Some people say to me, what's the most popular? The most popular, to be honest with you, is FX, is indices, and not necessarily commodities, but gold. Gold is very popular at the moment. It's understandable. It's increased a lot over the past 3 weeks. It's gone to all-time highs. Yes, it retraced yesterday, but nonetheless, you can really see why a lot of people got interested in gold. But what I will say is, somebody asked me, what's the easiest to trade? There is aspects of trading stocks which are easier. Why? Because there's less influence in it. If you're trading one individual stock, it's just that company, and there's less influence in it. And you're really narrowing your analysis to solely analyzing this asset. So there's benefits to that, of course. Disadvantages is there can be less volatility, there's less trading hours, but as a beginner, there is advantages to only trading a specific stock. What will I say in terms of correlations? What's influencing the price? We have bond yields. Why? Bond yields are expensive. The cost of debt becomes more expensive if people are paying more on their debt, so their rent, credit cards, mortgages, then they have less to spend at companies such as Apple, Amazon. So all these companies are earning less. So this is point number one. So bond yields have definitely an effect on the stock market. Risk sentiment as well, so an investment. So of course, if there's a risk averse market, it can have a negative effect on stocks. If there's a high risk sentiment, then it can have a positive effect on stocks, something that we saw throughout 2023, also at times in 2024. Monetary policy, so interest rates, we've already spoken about that, spoken about inflation, economic outlook. Low interest rates, low inflation, strong economic growth really helps the stock market. It creates a real good environment for stocks to increase. And the most important is, of course, the company's performance. So earnings, revenue, low debt, high cash flow, and so on and so forth. New products, new services, and so on. As the person who asked the previous question says, I'm making reference to the signal. Again, I can't see the signal, so it's hard for me to comment. Yes, by the sounds of it, that's the trigger point for you to sell based on what you're sending through to me as a signal. Indices, what are our indices? Indices, keep in mind, are equity indices. which is basically a group of stocks which have been pulled together. So it's like a fund of stocks that have been pulled together, grouped together, and they have one price, they're one tradable asset. So for example, taking 10 stocks, each of all of those stocks are worth $100. We group them into one asset worth $1,000. So there's 10 stocks in one asset. I'm adding all of the values up, it's $1,000. So very simple to understand. A lot of demand for this, especially the NASDAQ. As I stated, over the past 2 years, there's been a lot of demand for that. Influences are the exact same as stocks. Why? Because the index is being influenced by the individual stocks. What I will say is, though, keep in mind certain indices are weighted indexes. So certain stocks are more influential than others. If you're going to be trading indices, it's massively important that you understand that it's being priced based on the weighted method, which basically means based on the size of the company, certain stocks are more influential than others. Then we've got commodities. So assets which are physically you are able to take hold of. So for example, oil, natural gas, metals such as gold, silver, agriculture. This is largely being influenced by the economy, demand by the economy. Of course, demand by the economy also is affected by monetary policy, fiscal policy as well, which is basically government spending and taxes, politics, geopolitical tensions, and the environment. Don't forget the environment, as always, can influence commodities. ETFs. ETFs are very similar to indices. Think of them in a similar way to indices. Because there's one asset which is traded. This time it's traded actually on an exchange, and it's grouped assets being put together into one asset. The only difference is it doesn't have to be stocks. It could be different assets. It could be commodities. There's even cryptocurrencies ETFs now, which has really pushed the price of Bitcoin and cryptocurrencies up. So keep in mind this: a fund, grouped assets, one price, one asset, but it could be from different segments. Then we've got bonds, which are basically being issued either by companies or by governments. They use it to raise capital. It's basically borrowing. So they say we want to borrow X amount of millions. We're going to make X amount of bonds available in order to borrow that amount. And we'll pay you back within 5-10 years, whatever it may be. Probably the least popular asset which is tradable. I've got some more questions. What are features? What are futures? Futures, ladies and gentlemen, is actually something which has been around a very long time, even before the online trading market started. Futures originally started, for example, when somebody will go to another company and say, to build my product. For example, if we've got cheese makers, they may go to farmers and say, I need to buy milk. What used to happen is 1 week the farmer will say the price of milk is $10, the next week the price of milk is $15. And in order to avoid that, because of course I make cheese and I don't know how to price my cheese. I have no idea how to price my cheese because every week you're giving me a completely different price. So they created futures contracts. So they'll say, for the next 6 months future, this is the price which I'll buy milk at. Okay, so this is why it's known as futures. This is originally how it started as well. So it avoids volatility. So what is a future? Futures is like CFDs, but it's not as free. So futures basically say that you don't have to buy the product. You've got the option to buy the product. This is the price for the next time period, okay? And the futures may be a 1 month future, it can be 2 months, it could be 3 months, and so on and so forth. It's still a derivative. You're not buying the real asset itself, but you're pre-agreeing the price and the period. Whereas CFDs, it's more free. You can enter, exit at any point in time. Futures is more, it's still easier to get access to, but there's a certain expiry period most of the time. So traders' aims. Let's start looking at traders' aims and methodologies of trading. This is something very important because a lot of people say to me, what method should I be looking at? Let's look at point number one, scalpers. A big advantages of HF markets is they allow scalping. A lot of people go to other companies, they start scalping, and then they come and say, no, we're closing your account. We don't allow scalping. We of course allow scalping. We've got no reason why somebody shouldn't be allowed to close and open a trade in a certain period of time. We don't apply certain limitations. It's completely in your control, in your power, how to be trading. So what is scalping? Scalping and scalpers is basically when you are opening and closing a trade in a very short period of time. Now, some people, there's arguments about how traders are scalping. Some people say scalpers should only be opening trades for a couple of seconds. Some people say it should be for a few minutes. But technically speaking, it could be 10 minutes, it could be 5 minutes, it could be 15 minutes. But without that, it's for an ultra short period of time, and they're trying to earn small amounts. Now, scalpers basically say it's easier to earn a small amount rather than earning a very high amount. Somebody says to me, I want to earn $1 million. Somebody comes to me and say, I want to earn 10 cents. I'm going to say it's going to be easier for that person to be earning 10 cents. And that's the idea around scalping. Instead of opening one large trade, trying to earn a large amount in a quick period of time, people rather have smaller trades, more of them, and they're only trying to earn a small amount in a small period of time. So this is scalping. Like I said, derivatives, CFDs are mainly aimed for short-term trading, which is why I've got this slide as well. So of course, scalping is very popular for individuals looking for trading and looking for derivatives and CFDs. Then you've got intraday, which is very popular as well. It's still short-term, but it's not necessarily opening and closing in a couple of minutes, a couple of seconds. It could be within a couple of hours, it could be within 30 minutes, it could be within 6 hours, but it's within the day. Swing trading is short to medium term. This is when you're trying to earn from the whole swing, so a larger price movement, and it could be closing the trade within a couple of hours, but it could be closing the trade within a couple of days or up to 2 weeks. We're not including as part of this slide longer term because derivatives, CFDs are known, and a lot of regulators class them as inappropriate for long-term trading, building portfolios for the long term, such as position trading and so on and so forth. And then we've got news traders, so individuals looking to close trades in a short period of time and mainly trading where there's high volatility around news. What I will say is, especially for beginner traders which are going to be looking at news for the first time, keep in mind when you get the news and you get that big swing upward price movement, a lot of the time it will do this. Okay, so keep that in mind. Don't fall into that trap because a lot of people are going to be waiting there for you to push the price up because you're buying and then just come in and sell at double the amount and bring the price back down. So keep in mind, buyers want to buy at a low price, sellers want to buy at a high price. Sell at a high price. For example, if you're looking to buy a house, you want to buy a house at the lowest price possible. You don't want to buy at a high price. If you're selling the house, you want to buy at the highest price possible. So when there's news, a lot of people enter the market and push the price up, but larger traders are there waiting for the price to come up to take advantage of that and enter at a higher price to bring the price down. So keep that in mind, ladies and gentlemen. Also, if you've got access to so position trading is the same as swing trading. This is a question somebody's just asked. No, position trading is long term. Swing trading is short to medium term. Position trading can be keeping trades open for 1 month, 1 year, 2 years, even 6 months. So longer term trading method. But ladies and gentlemen, keep this in mind in terms of news trading as well. So let's move on to the next slide. We're coming towards the end of the webinar, ladies and gentlemen, as well. We've got approximately 10 to 15 minutes. So methods of analysis. Remember at the very beginning of the webinar, I stated 3 things. Number one, it's important to be able to identify the direction of the market. It's important, number two, to identify the period. And it's important, number three, to make sure the trading plan and the finance and mathematics around your trading plan allows you to be profitable. So let's look at point number one, identifying the direction. What methods do we have to identify the direction? We have three methods which are known in the market. The first is very easy. It's known as technical analysis. What is technical analysis? It's analyzing the price patterns, and indicators. Everybody knows what the price is. Everybody knows what price patterns are. For example, trends. Some people may not know what indicators are. What are indicators? Indicators are tools which you put on your charts, which give you a signal, they give you a direction where the price may move, potentially, based on the price movement. So it's still technical analysis because it's related to the price. Then we've got fundamental analysis. We're going to look at these in more detail over the next few slides. Fundamental analysis still is used by beginners, slightly more difficult though. Fundamental analysis is analyzing the aspect of the market which is affecting the price before the price movements. What do I mean by that? Technical analysis analyzes the price. So people have already bought or sold, which is triggering the price movement. So technical analysis is the last thing, is affecting the price movement, which is already taking place. Fundamental analysis is what is causing people to buy or to sell. So for example, saying there's a stock market crash, everybody's selling, I believe the price of this stock is going to decline. This is fundamental analysis because you're saying what is causing people to sell, which eventually will cause the price to decline. What is causing it is a stock market condition, a stock market crash. So fundamental analysis is looking at what is going to cause people to buy or sell. Let's look at an example. For example, COVID-19 caused the stock market crash. Why? Because all of these companies, except maybe online companies, were going to earn less. Why? Because everybody was in lockdown, everybody was super careful, unemployment rose, and so on and so forth. This is fundamental analysis. If we look at after that, when the market started to open, we could have stated that the stock market was going to increase. Why? Because interest rates were ultra low, which means everybody was paying very little on their mortgages, their rents, their credit cards, so people had more money. We've had the stock market crash, so everything is more cheaper, so people are more willing to buy it because it's cheaper. For example, if I came and said to you, Apple stocks are worth 180, do you want to buy it? You may say no. If I come to you in a year's time and say it's now worth 100, do you want to buy it? You may say yes. So you can see the sentiments of investors here. This is all fundamental analysis, okay? So keep that in mind. The last thing, point number one, technical analysis, point number two, fundamentals, are used continuously by beginners. Point number three, because there's a lot of educators out there which have no experience on trading floors, they're not financial advisors and so on and so forth, which is a big advantage here having me in the HF markets, is that you also are able to know what professional traders and large institutions do. Now, large institutions, they do use technical analysis, they do use fundamentals, there's a lot of benefits to that, but there's also a lot of benefits to order flow analysis. Order flow analysis is between fundamentals and technical analysis, and it's basically using tools which will show you how many orders there is in the market. So for example, cumulative delta will say to you there is 200,000 buyers today and there's 50,000 sellers today. Are you going to be buying or selling? Potentially, most likely, people will look at where there's opportunity to buy. If order flow comes and says to you there is 400,000 sellers and 100,000 buyers, potentially you'll look at where there's opportunity to sell. This is order flow analysis. The Do ICT and CMC fall under order flow analysis? Depends. It can, as long as being linked to an order flow analysis feeder, sorry, order flow feeder. A lot of the times though it's not, because it's being moved based on volatility rather than order flow. If it is though being moved on order flow, so it's linked to order flow feeders, then yes, it is known as order flow analysis. If you type in order flow analysis tools on Google, because we've got a lot of beginner traders here, and I can't look at order flow analysis, which is more advanced, for quite a long time. Keep in mind, if you type order flow analysis on Google and on YouTube, a lot of things will appear, and there's a lot of information, especially also even under our websites and sorry, our YouTube page as well. So order flow analysis, there's a lot of advantages to that, because it shows you how many buyers, how many sellers, what is the volume, what is the volume weighted average price, where people are placing pending orders, if there is pending orders, and so on and so forth. So there's a lot of advantages to that. I will show you an example of this as well. Let's look as well here at examples of technical analysis. So here we've got the chart. So of course it's technical analysis because it's related to price. Here, ladies and gentlemen, we can see there's a line. This is what is known as a moving average. Here we can see there's a line of 4 areas. We've got above 75, between 50 and 75, between 25 and 50, and below 25. This is what is known as an indicator as well. This is an oscillator. These are tools, okay? These are technical analysis tools. Here we've got what is known as a regression channel, so free zone regression channel. So you can see a trend zone, a retracement zone, and a correction zone. So trend, retracement, correction. This is a regression channel. These are technical indicators. I'm not going to go through all of them. I'll give you an example of how they can help. Here, the oscillator, the blue line drops below the 25. It indicates the price is too cheap. This, okay, indicates that it even may lose momentum or the trend may change. So you can see we started to get the indicator here, and we started to lose momentum, and then after it completely changed, completely different trend. So you can see how this indicator here helped us, because it told us it was oversold, it was too cheap, and there was a risk of the trend changing. Otherwise, if I didn't have that, I could have seen the price declining and saying, price is declining, happy days, let's speculate a decline. No, there's an oscillator here, it told us it's oversold, it may lose momentum or a trend may change, and that is indeed something that actually took place. So you can see here how technical analysis assists. I've got another question. Order flow analysis. What kind of info, pending order, etc., is accessed? Anything which is related to orders is being accessed. So it could be pending orders, it could be market orders, it could be how many orders have there been today, at which price are most of the orders being placed, which are known as volume profile. There's a lot of things which are accessible. Again, type it in on Google and you'll be able to see all the different tools which are available. The only reason I'm not saying more about this is because I could speak about this for hours and hours, but it's slightly more advanced. What I'm trying to do here as the webinar, which is beginners and a beginner's guide, is to guide you in which direction for you to potentially look at in order to better yourselves as traders. Of course, we will have, though, without doubt, webinars where we're focusing solely on order flow analysis, for example, as well. Fundamentals. I'm giving an example here as well. This is the German DAX, so it's an index. We spoke about indexes. It's 40 stocks which have been grouped together into one asset. Here, ladies and gentlemen, on this day, we had France, Germany, and Spain released inflation data. The inflation data was lower. As I stated, that is positive for the stock market, and we can see how that caused the price of the index, the DAX 40, to increase significantly. So this is an example of fundamental analysis. We'll look at this and then we'll look at order flow analysis. What I will say is, as part of this slide, we'll go back a slide. Here we can see candlesticks. This is a type of chart, candlesticks. Candlesticks are very easy to understand. You either will see a green candlestick or a red candlestick. You can change the colors if you like. It's basically a bullish and a bearish candlestick. If the price is bullish, it means where the box starts here, this is the open price, and where it closes, this is the closing price. So the open and the closing price. But the wick shows the low and the wick shows the high. So it always will show you the open price, the closing price, but within that period, it went as high as this and as low as this. Also keep in mind that candlesticks are symbolizing a specific period, and that depends on you personally, because of course you personally are going to choose if you're on a 1 hour time frame or a daily time frame. If you're on a 1 hour, each candlestick shows price movement for that 1 hour. You also have pending orders, which is basically not when you buy and you instantly buy straight away. Pending orders will say, at this price, I want you to speculate that the price will increase. At this price, I want you to speculate the price will decrease, and so on and so forth. So here you've got what are known as stop orders, which are pending orders. So here we can see those. So this is basically saying, saying that when there's enough momentum in one direction, open an order for me. So here it basically says if the price increases to this level, buy automatically for me. That's a buy stop. A sell stop is saying if the price declines to this level, sell automatically for me. So for example, somebody may say, we're looking at an upward trend like this, and I'm currently in a retracement. This is where I'm at, which retracing. So I can see it's an upward trend, but I don't want to buy yet. Why? Because it's retracing. Why am I going to trade where the market's retracing? It's moving against me. But if it moves this high, that's enough for me to believe there's enough momentum upwards for the trend to continue and continue seeing the same pattern. If so, you can place a buy stop, which basically says that as it does this, it will automatically buy for you without you having to be on your computer or buy physically yourself. Then you've got a different type of pending order. These are known as limit orders. This is basically saying to sell when the price is too expensive or to buy where the price is too cheap. So for example, the price may be doing something like this, and I say if it goes this high, it's too expensive for me. So I believe at that level, it's going to actually start to decline. So you place what is known as a sell limit. So if the price increases to this level, it will automatically open a trade that will speculate a decline. That's a sell limit. So this is why here I've got a diagram which shows it goes up and speculate a decline. A buy limit is when it goes down and you speculate a price increase. So the difference between the stop orders and the limit orders is the stop orders is when you're trading the direction of the trend. The limit orders is when you're saying actually the trend is about to change. When you're looking at fundamental analysis, you should always be looking at these 5 pillars, which is basically interest rates, inflation, economic growth, employment, and consumer and investor sentiment. If you're looking at these 5 pillars, you're doing 80% of order, 80% of fundamental analysis. And you've also got certain assets to assist you with risk. So for example, you have a take profit here. What is a take profit? Let's say again, we're looking at a trend, something like this, and I'm buying here, I bought here. I believe the price is going to go all the way up to here. You can place a take profit here, which basically is a preset price in the market that you set, which says if the price increases to here, I want you to automatically close and cash in my profit. Okay, so for example, if I'm buying at $100, I can sit there and say, I'm going to place a take profit at $105. If it goes up to 105, our system will automatically close the trade, put the $100 that you invested back into your account, and the $5 profit again back into your account. This is a take profit. Applies to both. If you're speculating the price is going to increase or decrease, the same thing applies. Then you've got a stop loss. This is the same thing, but related to risk. So when the price is moving against you. So again, price may be doing this. You may be speculating here that the price is going to increase, but the price actually decrease. It's saying, you know, at this level, I'm not willing to risk more. So if it goes down to here, close the trade and put the money in my account. So for example, if I buy $100 and I'm investing $100, I may put a stop loss at $30. This is just an example. This is very far away, but it's just an example. So it will automatically close at $30 and put $30 back into my account. So I'm saying to basically say I'm not willing to risk more than 70%. Again, a lot of people won't risk that much, but just an example. How do you set break even and close half profits? What you can do is use scaling in and scaling out. This is something which is easier and gives you more options rather than looking at automatics and closing half trades and so on and so forth, which gives you less options. This basically is saying, instead of opening, let's say you've got a price movement like this, okay, and like this, instead of opening here, one trade, let's say one lot, instead of opening one lot here, speculating upward price movement, instead of doing that, I've opened 10 trades, okay? So I open 10 trades and I'm only opening 0.10 lots. So I've got 10 trades at the same price, but smaller trades, okay? So instead of opening one lot at that price, I open 10 trades at 0.10 lots, so 10 times smaller. So what does this do? This allows me to enter at the same price. It's the exact same thing. I'm being charged the exact same. But what it actually does is it allows me to say one trade I'll close here. So 10% I'll close here, 10% I'll close here, 10% I'll close here, and so on and so forth. This is what is known as scaling out, okay? So this is an option which you have. Option number 2 is you can open smaller trades at multiple prices like this, which is scaling in, and also look at multiple exits as well. Or you can look at only multiple enters and exit them all at the same price. It's absolutely fine. This is what is known as scaling in and scaling out. So this is a great option which you have in regards to what you're referring to. The last thing which I will say besides stop loss is trailing stops. The difference between trading stops and stop loss is that a stop loss is static, it will never move. It's basically saying, you know, if I'm buying here at $100, I'll place a stop loss here at $90. Okay, if the price goes up here to $200, okay, my stop loss will stay at $90. It won't move. If I place a trailing stop, this trailing stop will continue to increase with the price and actually increase to $190. Okay, so it follows the price movement. So if then the price declines by $10, it will close the trade. So actually it's protected my original investment and protected 90% of my profit. Okay, so this is a trailing stop. This is the second to last slide. This is order flow. Just wanted to give you an example of order flow. It's actually candlesticks. Some people may look at this and think, wow, that's really difficult to look at. It's the exact same as candlesticks. So you can see the bars. So this was the lowest price. This was, sorry, that was the highest price. That was, sorry, that was the open price. That was the lowest price. But the numbers will show the high and low. Again, this was the open price, this was the close price, but this was the low, this was the high, this was the lowest price, this was the highest price, low, high. It's the exact same as candlesticks. The only difference is there's numbers there. What are these numbers showing? It's showing you how many people are buying, how many people are selling. If there's a big difference between buyers and sellers, in favor of sellers, it's actually highlighting it in red. So for example, here you got it highlighted in red, here you got it highlighted in red. So you can see all these red highlights, and it's actually triggering the price to decline. Here you've got different statistics as well, cumulative delta statistics, volume, and so on and so forth, that you can use as well, of course. But I just wanted to give you an example of order flow analysis because a lot of people asked about it today. Creating your trading plan. This is something very important. We're going to look at just the very basics of this. If you want to give yourself the best possibility to be a successful trader, there's benefits to only trading one asset. The biggest mistake a lot of people do is they've entered the financial trading market for the first time, they've never traded before, and every single day they're trading a different asset. Or within the day, they're trading multiple assets. This is bad because each asset is different. So if you every single day trade a different asset, your knowledge is again starting again from the beginning. So if I'm trading for this week the Nasdaq, and next week I start trading the DAX, I'm starting again from the beginning. I know nothing about the DAX. So the advantages of only trading one asset, only one asset, doesn't mean you're going to earn less, doesn't mean you're going to trade less. I may trade one asset, you may trade 10 assets, but I trade more and I earn more. Okay, for example, this is just an example. So it doesn't mean you earn less, doesn't mean you trade less, but there's advantage to only trading one asset. Okay, this is something I say again and again and again, because it's so simple, so simple. Anybody can do that, but no one does, which is why a lot of people struggle. You know, they say to me, last week I was doing really well, this week I'm doing terrible. What happened? And I said to them, what did you trade last week? And they said to me, I traded the Euro USD. Are you trading the Euro USD this week? No. So why are you comparing it? Okay. Think about it also if we've got students in. When you go to university, are you going to one university studying one degree, or are you going to 3 different universities studying 3 different degrees? You're studying one because it gives you the best possibility to pass. You could go and study 3, but the possibilities of you passing are very low. The same thing applies to trading. Which session are you going to concentrate on? This again narrows it down to help you as well, because each asset acts differently in different sessions. So if you're trading one asset in one session, again, your experience and knowledge increases. Ensure you're opening an appropriate trade size. Your trade size shouldn't risk your account. Your trade size should be responsible, and it shouldn't overexpose you. Reward to risk ratio. How much per trade are you looking to earn, and how much per trade are you looking to risk? You should know your success rates after trading 1 week. So if you've been trading 1 week, go back to your trades. Say to yourself, I've opened and closed 10 trades. How many of them were in a profit? It may be 5. So I've got a 50% success rate. So I need to look at my reward to risk ratio. I need to look at how much I'm trying to earn and how much I'm trying to lose. Because if I've got a 50% success rate, and which basically means half of my trades are in profit, half are in loss, and I'm looking to earn $50, and I'm also looking to risk $50, so my reward to risk ratio is 1 to 1, I'm not going to be in profit, so I'm wasting my time. Whereas somebody may be saying to them, somebody may be new, may have a 30% success rate. Now, if I say to you, would you rather be the person with a 30% success rate or somebody with a 50% success rate? Everybody will say, I'm looking to be a 50% success rate. Everybody will say that. But what if I then say to you, this person with a 30% success rate, so he's not great at trying to identify the direction of the market, but he's looking to earn, excuse me, he's looking to earn, let's say $60 per trade, and he's looking to risk at $10 per trade that he's losing. Okay, so he's got a 30% success rate. He's opening 10 trades a week. So 3 were in a profit, 7 were in a loss. This basically means he had a turnover of 180, and he had losses of 70. So he's actually in a profit of 110. So this person with a 30% success rate is actually more successful than the person with a 50% success rate. So this is what I referred to at the beginning. It's not just about you being able to determine how the price is going to move or how the price is going to move in a specific period. It's not just about a strategy. Something which is equally as important, sometimes can be more important, is look at the mathematics around your trading. That could make the difference. You looking at the mathematics around your trading. How many trades am I opening? How many trades am I going to open? How much am I looking to earn? How much am I looking to risk? And if you stick to that strictly, you can determine before the week even starts how you are potentially going to how this week is going to end up for you. Now, if you are beginners, okay, one week you may have a 30% success rate, the next week you may have a 50%, and so on and so forth. But as you gain more experience, that will start to look the same every single week as you gain more experience. So keep that in mind. The next thing is, if you are beginners and every week is different, you can use your average success rate. You can use your average towards the lowest success rate, okay? Don't take into consideration that one week where you had an 80% success rate. Exclude that. Look at the weaker weeks and so on and so forth. So this makes a very big difference. Also use a trade journal. Go back to your trades and look at what went well, what went wrong, and if you can make improvements. So if you look at all your trades where you were successful, and the price movement looked like this, you opened here and you closed here, and let's say I had 10 successful trades this week, and every single time this was the scenario, I'm going to look at my trade journal and say, gosh, I could have kept hold of that slightly longer. So maybe this week I'm going to increase what I'm trying to earn per trade, because in every single scenario that I'm right, it moves in my favor for longer. For example, I could do the same for trades where I'm losing. Okay, every trade that I close in a loss. If the price movement looks like this, I open my trade here and I close my trade here, but on every occasion the price does that afterwards, I'm looking at my trade journal saying to myself, next time maybe I need to give the market more time, but you need to be strict about it. Okay, that's the main thing. You need to be strict about it, otherwise the mathematics is not going to work. So ladies and gentlemen, we've been speaking now for a long time, been speaking for 1 hour and 20 minutes. We've gone definitely overpulled on the time. I do apologize for that. If anybody has any questions, feel free to ask now. I can see some people have questions. I've got one question actually. Feel free to ask as many questions as you like now. How do traders make profits in futures? Depends on what type of futures it is. If it's futures like the example that I gave, where it's more of a physical future, you're making money basically. For example, if somebody's saying to themselves, I will buy this asset, let's say it's gold, I will buy gold for $2,000 for the next month. Okay, so for 1 month, in the next 1 month, the price actually went up to $220. Sorry, $2,200. Then I've actually made $200. Okay, if the price declines to 1,900, I'm actually losing on my future $100. So a lot of futures work like this. It depends though on the future though. Keep that in mind. It depends on the future, because there's different categories. There's spot futures, for example, and there's warrant futures. There's a lot of different types of assets. Any other questions, ladies and gentlemen? we have any other questions, feel free to ask now. We'll leave the webinar open a couple of more minutes. I've got a lot of people here saying, please can we have the recording? Yes, of course you can have the recording. You can request it from live chat as well. You can also see it online, the recording. That's absolutely fine. I cannot see any other questions, so let's end today's session. Trade safe, trade responsibly, as always. I wish everybody a great day. Hopefully you found today's session educational and informative. In the meantime, we've got another webinar tomorrow. We've also got a live stream webinar looking at live analysis on YouTube tomorrow as well. Otherwise, we'll see you again next week. In the meantime, take care, and hopefully you found today's webinar educational. In the meantime, goodbye.